Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining us. And tonight I've asked my four experts, including myself, so I guess I asked my three experts, to give us one stock that they think will do well over the next year, where you'll make some money out of reliable, quality businesses. I've got Jun Bei Liu from Tribeca Alpha Plus, I've got Julia Lee from Berman Invest, and Paul Rickard from the Switzer Report, and also I'll throw my tuppence in there as well. Now, before I go to Julia Lee, let me give you my thinking on the subject. You know, if I wanted to play it safe, I'd probably go for a company like Qantas, where the experts on the FN Arena, and the FN Arena surveys company analysts or experts who specialise in looking at these companies and trying to work out where they're heading. Now, the average for Qantas is about 9.2% upside. And I think that's believable because as the Aussie economy reopens and we start flying again, I think a company like Qantas, its profits will improve, the attitude towards Qantas will improve, and the share price will go up. Another company I like, which is also part of the reopening trade, because that's what Qantas is benefiting from, the reopening of the economy trade, is a company called Tyro, which I've invested in. I'm invested in Qantas as well. I invest in companies I've got skin in the game with, but I think Tyro is a company when we go to cafes or pubs or restaurants and you see a Tyro machine there when you put your credit card there after the meal. This is a company that will do better once we start going out again. So I figure it's going to do well. The market's kind of anticipating it, but I think progressively over the next 12 months, this business will do well. It's got a banking license, and it really goes after a lot of small businesses that use their terminals will also do business with Tyro. So I think that's a pretty good one. But I want to go for something that's really risky. So I'm taking a bit of a punt here. But this is a company that has always been perceived as being a quality company, but really has been smashed in recent times. You'll see on the chart in front of you now, this was a $40 stock. The name of the company is Appen. It's got a ticker code of APX. And if you go and look at what the survey of analysts are saying, they believe this company has 47.2% upside. But that's just the average. If you look at some of the individual analysts, they really have, every one of them thinks the stock price goes up over the next 6 months to a year. But the range is actually quite interesting. So you've got one saying 26% rise, another one says 17.5% rise, another one says 44.2%, and the analyst at Citi thinks 100.85%. Now, even if these guys are only quarter right, the average would be a 12% gain, and if the guy at Citi or the girl at Citi is right, it'd be a 25% rise, even if they're only quarter right. So when I start looking at it, this is a company worth having a punt on. Now, when you think about it, this is also a company in the space of future business. It provides data for artificial intelligence and machine learning. And every time I talk to the smart young tech people out there, this is where we're heading. So it's kind of in the right industry. It's had problems. You can see it was a $40 stock. This chart on the screen shows you. But I just think this company over the next 12 months will start to improve as America, because they do a lot of business with the big tech companies out of Silicon Valley. As America gets back to normal, fingers crossed, the Delta strain is actually beaten and we do get back to normal. This is a company that I reckon will be a beneficiary. Also, there's an analyst out there called Simply Wall Street, and this is what they said. I quote them: "We think that the softer headline numbers for Appen might be getting counterbalanced by some positive underlying factors." And they also said this: "We think Appen's earnings potential is at least as good as it seems, and maybe even better. And on top of that, its earnings per shares have grown at 65% per year over the last 3 years." So there's a lot of positive stuff around a stock that was perceived as being a quality company. It didn't benefit from the coronavirus periods and the impact it's had on the economy. So it's probably worth a punt. I'm not saying it's a quality company that you guarantee it's going to head up. I just think it's a good quality company with the good chance that it might actually surprise on the high side. Yes, I'm invested in it, not a real lot, but I'd like to see it go up in the right direction. And as you can see from my argument I just put out then, there's pretty good reasons to believe that it can head in the right direction. So that's my offering for the stock that I think will do well over the next 12 months. Now let's go to Julia Lee of Birmingham Invest and see what she's thinking. Well, joining me now is Julia Lee of Birmingham Invest. And Julia, great to see you.
Great to be here, Pete.
Before we get that one stock that's going to be a fantastic money maker for everybody over the next years, fingers crossed, let's talk about what happened today. I know in the Switzer report, Julia, I wrote about 3 or 4 weeks ago, September is usually a pretty crummy month. But what are the main triggers for the negativity in the market today?
Sure. I guess if we have a look at September, if you look at the past 20 years, it has been the worst performing of the year. So an average return of minus 0.9%, which we're above at the moment or below at the moment. So doing worse than that average. But having a look at the drivers to the loss we saw in our market, because the Aussie share market was down 2%. First of all, over in the US, it was quadruple witching hour, which is the expiry of options and futures. And that leads to a bit of volatility. So we saw a negative lead coming through from the US on Friday. Add into the mix, there's a lot of nervousness around Evergrande, which is one of China's largest property developers. So that's a big risk this week that we are watching. And that's caused a lot of volatility in terms of the iron ore price. In fact, having a look at the most closest futures contract, which is the October iron ore contract. And in Singapore, we saw prices falling around about 10%. So our material sector under a lot of pressure. And then add into the mix, we also see the FOMC meeting over in the US this week. This is a central bank meeting. Investors are nervous about more talk around tapering, although I think they're going to put off that decision given that we've seen weaker employment numbers, the risk of Evergrande, and I guess just looking at those COVID numbers in the US as well, and they've been rising as well. So I guess the key for investors is whether, they take some risk off the table, which we saw happening today, or whether it's a buying opportunity. Look, Pete, looking at the market, and we were above 7,600 points not too long ago, and today we were around about 7,200 points. So that's a pullback of around about 5% already. And generally, at least once, if not twice a year, you see a pullback of 5 to sort of 10%. So it's a question of whether we've seen that 5% pullback or whether we see a deeper pullback to around about 10%. Previous pullbacks in the last 18 months have been very shallow. So we've started to buy on this 5% pullback. We were in about 30% cash, hoping for a bit of a pullback in September. And we've started to put a little bit of that money to work. So there's been a bit of buying in terms of the market, even though there are some key risks watching Evergrande, because I don't think the Fed's going to talk really too much differently to last month around tapering.
Yeah, there's talk out there that Evergrande could be a new age Lehman Brothers, but I think my view is that the Chinese government will not let a company like this fail. They will just they'll punish the executives, but I think the company itself will be propped up by Beijing of some kind, and I don't think it'll be another Lehman Brothers.
Well, I guess the difference between China and the US is that so much of it is controlled by the state. So last week we saw a big liquidity injection, I guess also ahead of that autumn harvest holiday that we are seeing around Asia. In fact, today, markets in Korea, Japan, and China were closed for that holiday. And I guess that meant that some of the trades that would naturally go through those markets probably found their home in Australia, given that we were open, where a lot of the markets around the region were closed. Usually on a day like this, it's pretty quiet because it's also school holidays here in New South Wales. But today, the volumes were quite high for a Monday. So I suspect we were seeing some international traders coming into the Australian market, given a lot of our region was closed today.
And remember, you being a parent knows school holidays have been on for a long time in Sydney and Melbourne. Okay, let's go to the stock, because you said you're holding cash. You must have bought some stuff today. So what's the one Julia Lee destroy a stock that's going to do well over the next 12 months?
I think this is a good time to talk about sort of what I look for when I'm looking for companies that I think will go up in value. And one thing that we do look for is an improving outlook. I also like to look at not only cyclical trends, but structural trends in the market. These are big shifts in terms of the market. And today we saw all commodities being sold off. It was a little bit like the baby being thrown out with the bathwater. So I can understand, iron ore, the fundamentals are relatively weak at the moment because there's a risk of construction slowdown. And of course, iron ore is the key ingredient in steel, which is used for building buildings and as well as infrastructure. So look, I'd be revisiting that iron ore space probably towards the end of the year in December, because I think iron ore prices will be relatively weak till about February when we see the Beijing Winter Olympics. And after that's on, we might see a bit more spending in terms of infrastructure and ramping up in terms of steel. But in terms of those structural trends at the moment, outside of iron ore, there's other trends that are happening as well. And the world is moving towards net zero, and that's causing money flows as well as, I guess, the way investments are happening in the commodity space to change. So I still think that electric vehicles and the battery story isn't over. We did see a bigger fall in terms of some of those companies today. So it wasn't unusual to see an 8 to 10% fall in some of these companies, but that was simply because it was a risk-off market. When we do see prices fall this much, generally the higher beta or the higher volatility stocks tend to fall more. And that's exactly what we saw. It wasn't that the underlying fundamentals of the company has changed. And when we see that disconnect, often I see the opportunity to jump in there. The other area I like, which I've spoken a lot about, Pete, is the fertilizer area. Look, fertilizers in Europe reaching a record price, and part of that story is because of the electricity price over there, which is at record highs. But fertilizer companies here in Australia are in a good spot. And I think a couple of weeks ago, I spoke about New Farm. That stock has continued to rally, but we also like Incitec Pivot as well. So we've been adding to positions in Incitec Pivot today as well. And I guess the good thing about some of these fertilizer companies is that they don't report in August. They report in November. So there's an extra little catalyst down the road as well. So I'm liking those fertilizer companies, given the relatively good weather we've been seeing here in Australia for planting and cropping.
Okay, but you got to give me the one stock, the one of all the ones you've done. Because, like, for example, you've done fantastically well with Pilbara Minerals. I guess Pilbara's come off today, but that's been a really good call of yours. But what's the one that if your beloved relative came to you and said, Julia, you're the genius, I want to make money, what's the one stock that you would say, I'm going to make money out of this year?
Well, if you're looking the next 6 months, I'd probably say Orocobre, because they are due to come out with a better estimate of their resource, which I think will be a positive event. Yeah. And of course, the growth story there. But if you're talking about the next 1 year, probably New Farm. I think it's oversold at the moment. The market's too pessimistic. It's already started to bounce back, but I think that bounce is going to continue.
Okay. Thanks, Julia. Love putting you on the spot. Thanks for coming on the program. Talk to you next week.
Thanks, Pete.
Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Up now is Jun Bei Liu of Tribeca Alpha Plus. Jun Bei Liu, great to see you.
Great to be here, Peter.
Before I get your stock for the year that we'll make lots of money out of, let's talk about today. How worried are you about the sell-off today?
Look, I'm not very worried. Share market has performed very well since the beginning of the year until now. We're really just taking a bit of off the table. If you look at what's being selling off, it's really everything. So really just investors taking some money off the table, given they made a lot of money and we had a good reporting season, and just really, just take a bit of breather. That's all it is.
Yeah, and September is renowned for being a pretty crazy month for stocks, isn't it?
Yeah, normally September actually have proven to be pretty weak for most of share markets around the world, actually. And normally the share market does bounce back quite sharply around October, and December quarter normally is a pretty good quarter to end the year, as people, investors are become more optimistic heading into the year end and Christmas. And this year we certainly expect so as well, just simply because, you know, we just gone through the Delta variant and the lockdown and everything. But in the next few months, we really will have the economy reopen, and you have more mobility, people are spending on services and the like, so you will see better economic data in the next few months.
Yeah. What about the question marks over that company called Evergrande in China?
Yeah, that's a really good question. It's the second largest property developer in China. The problem it has is that it has a lot of debt, and now it can't pay back a lot of its debt. But the thing is that most of its debt is within China. It's not actually from foreign investors. And the issue is if it goes, it couldn't repay its interest payment. Not only there's stranded homeowners and millions of employees. It's also issued a lot of issue a lot of wealth products. So there's a lot of investors for many of its other products. So potentially that was a bit of a worry that, create a bit of a contagion across into other companies, whether it's property sector or whether it's wealth product, investors essentially become forced sellers of those things. Now, at this stage, China's on holiday, and this week is quite important. There's expectations for the government do help out at this level for them to manage its way through. But look, at this point, it certainly still seems like the problem is contained within China.
Okay, right. Let's move to the stock that you really like for the next year ahead, and why.
Yeah, look, sometimes I think the share market is a moving feast, because the more down days like this, the more companies I will have to to talk about. Look, today I prepared this one, which is Ramsay Healthcare. Now, this name is actually, we all know this company is the premium lead private hospital group here in Australia. It's the largest, and it owns lots of private hospital assets in all the premium locations around Australia. Many years ago, it went into offshore, so it went to France and went to UK, and in those markets, it's gradually building a very strong market share in those markets as well. So leading market private hospital operator, and the reason we like it is because its earning has been significantly impacted by COVID, and it's at this stage, New South Wales elective surgery is still on hold, but all we know is the waiting list is really building up, and for the brief moment when we could travel and when we could do all the surgeries, the waiting list, the demand was enormous until the latest shutdown. So we know people are lining up to perform a lot of those surgeries, and hospital surgeries are very, very defensive. So this company is still trading at a price level that is below pre-COVID level. It is very cheap compared to its other healthcare peers, such as the Cochlear or ResMed. They are trading on an average of about 40 times earnings, whereas Ramsay is trading on just over 20. It's looking cheaper even compared to the Wesfarmers, where its earnings will actually fall double digit in the next few years. So, put it together, it's very cheap, it's very defensive, and it's a very premium sort of infrastructure-like asset operator, at a bargain price. So to us, it's a no-brainer.
Okay, and I think we may have talked about it a couple of weeks ago, and it has gone up ever since we started talking about it. And it was probably you who brought it up then a couple of weeks ago. But I was actually asked on Sky News this morning about the possibilities of a French reaction to the subs problem, the rejection of the French submarine contract. And it just kind of occurred to me that a company like Ramsay is dependent on the French government for support, because all hospitals are. Have you considered that there might be a curveball there if the French want to get even with us?
Yeah, so the key difference is that actually this is quite different from how China would respond to Australian companies operate there, or French, and how French might respond. Now, as far as the French consumer is concerned, Ramsay don't operate in France in the Ramsay brand. They bought a local business and then still operated by the local management, 100%. So they are become a capital partner. They bought into it. And then they brought expertise and then a lot of back end and things. But the front end is still French people running those businesses, because it is expertise. In France, relationship is very important. You can't just, Ramsay didn't just go in there, completely change the management and replace with Aussie, that sort of management. So it is still considered French business. And so we just haven't had a significant example of crew like what, the Chinese businesses or Chinese companies that have responded, or consumer has responded to some of those businesses that do operate in China.
Yeah, I know. I guess we sometimes assume that what China does could be mirrored by other nations, but there is a tendency for other nations to play a little bit fairer than Beijing.
Look, we'll see how that play out in Beijing. It certainly is getting to a point where we will see more news flow and the like coming through in the next few weeks on that front. Geopolitical tension is picking up, as we have seen all the headlines. But at this point, it's still, in my view, still doesn't upset a stronger share market sort of investment thesis.
One last one, Jun Bei. Obviously, the iron ore miners have come off the boil, their share price is down. Do you ever buy miners if you think they're good value?
I do buy miners. I think they represent opportunity to make a really significant return. Now, iron ore miners, we have made a lot of money out of them in the last, last 2 years, the price has come off significantly. Now, the iron ore miners certainly looks very cheap, but it is too early to buy those names at this stage. Now, I do like some of the other names where the commodity price is well supported. So things like lithium, if you look at the current lithium prices, and then you mark to market, the lithium operators such as Pilbara or Orocobre, the earnings would double. So, you do want to play in commodity companies that has earnings upgrade to come through rather than downgrade. For the, iron ore miners, earnings really downgrade that's coming through now.
Okay. Thanks for joining us on the program. Talk to you in 2 weeks' time.
Speak soon. Thank you.
And that was Jun Bei Liu of Tribeca Alpha Plus. And before going to Paul Rickard, I want to remind you that the Switzer's 6th Small and Micro Cap Virtual Investor Day is on Tuesday. That's next Tuesday, the 28th of September, from 9 a.m. to midday. Now, if you're looking to stay ahead of the market and discover companies with growth potential before other investors, maybe this might be the event for you. As a valued subscriber, you get exclusive free access to our event. It is our mission to bring you practical, actionable, and expert recommendations at our virtual events when it comes to growing your wealth. And you'll get a chance to listen to the MD or CEOs of these companies, and you'll also get a chance to ask them questions as well. Of course, we're not recommending these companies, we're just putting them on show for you to have a look at. And I've got to say, the history of these microcap conferences, lots of these companies have done very, very well. Now, you'll see on the screen right before you the companies that will be presenting next week. I hope you can join us, and if you do, just go to our website and register for the event. Well, joining me now is Paul Rickard from the Switzer Report. And Paul, I've challenged you with the same as I have with everybody else, one really good stock for a year that we will definitely make money out of. What's your hot stock?
Well, you know me, Peter. I came up with two, not one, just to make it more difficult for you. One I describe as a bit riskier than the other. I'll go with the risky one first, and that's Qantas. It's gone up a little bit in the last month or so, particularly as Alan Joyce has talked more and more about getting Qantas ready for a December liftoff. But I think we're seeing so many signs now, Peter, that that's going to happen with the vaccination rates in New South Wales and Victoria. We're also seeing both states, or at least 3 states now, talk about home quarantine. That's really important for Australians wanting to go overseas. The last thing people want to do is spend 2 weeks cooped up in a hotel room with no fresh air. That's a real barrier. So these sort of things are actually giving, I think, a lot of impetus to getting the airline back and flying internationally. There's huge pent-up demand. We've seen what it's done overseas. We knew that during the pandemic, Qantas took a lot of steps to change its cost base. It's also going to benefit enormously from the collapse and the rebirth of Virgin. That's got to be a long-term positive. And then they've rejigged their international schedules and got rid of a lot of unprofitable routes. So when the economy starts to fly again, and I mean that literally, I think Qantas is going to do really well. My only concern is it's already had a fair bit in the price, but I think there's a bit more to come, Peter. In a year's time, those who buy Qantas will be looking back. That's the more aggressive play because, you know, they may not get it launched in December. Who knows what could happen? We might have an epsilon wave or whatever comes after Delta. Who knows next? But that's the riskier one. The safer one, and perhaps the more boring stock, is CSL, Australia's best healthcare company, Peter. I just love CSL for all the right reasons. It consistently outperforms. In other words, it tells the market one thing, delivers results that are better. There's very little between results season. I just think it's a really well-run company, and I think this the pandemic has got to be good longer term for health companies. I think we'll all be a lot more conscious of these things, and you know, once we get through that, that'll help with the collections of blood plasma in the US. Will also help in terms of their influenza business, their vaccines business.
Yeah. So when you look at CSL, Paul, and you're right, it is a more boring stock, consistent with your personality, and I suspected you would do that. It's amazing that you went for a risky one.
Well, you know me, Peter, I want to keep you on your toes, but I went for the riskier one first, right?
That's right. And it's interesting because both you and I a few years back used to say we'd never buy airlines or insurance companies. But Qantas, you're right, he's got that less competitiveness from Virgin. I think John Borghetti was far more aggressive in trying to take on Alan Joyce, particularly with business flights. But the interesting thing also is, Paul, that both stocks really are what you might call reopening trade stocks because they both suffered during the coronavirus period. In the case of CSL, why don't you explain to the audience why CSL, a blood plasma business really, had difficulties during the coronavirus period in 2020?
Yeah, look, its main business is the products that come out of blood plasma, and it's about 85% of its profit comes out of that. It's also got a vaccines business, but look, that's small bickies compared to blood plasma. And the reason I want to say it did it tough, Peter. It still managed to lift revenue and lift profit, but it didn't do it quite at perhaps at the pace it was probably planning to, was that in the United States, where most of the blood plasma is collected, it tends to come from what you might describe as working class American blue collar cities. Most of the donors get paid to deliver blood. And during the pandemic, when a lot of the cities were locked up, donations stalled a little bit. They had to put a lot more expense in terms of collecting the actual specimens. A lot of people were turned away because they couldn't prove they'd been vaccinated or they didn't have COVID, couldn't pass a test. So it actually disrupted the supply of blood plasma products. And CSL's always argued it's not so much the demand for the products they make, it's actually about the collection of the blood plasma. So that's probably the major reason. There's probably also, I guess, on the demand side, Peter, some of the, there's a general slowdown in some of the operations and the things that people diagnose CSL products for. I guess probably didn't help as well. But look, that's been the main reason. And but they're still forecasting, good revenue growth this year and good profit growth. And the only problem with CSL, Peter, is the multiple. It trades at a pretty big multiple because it's been such a great performing stock. It's on a multiple almost 40 times earnings. Now, if we get a sustained re-rating of models, we go into a big bear market, I guess that's going to come down. But my guess is CSL is going to be one of those companies that's going to be well supported even in a bear market. So that's why I think it's a more dependable bet. You won't make as much, but there's a lot less downside than there is in Qantas. But there's two. I know you asked for one, but I thought I'd be just a little bit different.
Well, I know I'm going to probably put three forward, but only just drill down to the one I'll put my reputation on. But Paul, another interesting point is also that because of the coronavirus, less car driving, less car smashes, probably even lower crime rates. People were staying home and not out there committing crime. All that sort of stuff means even less demand for blood. So you got supply and demand. And you're right, a lot of hospitals that used to do elective surgery were doing coronavirus type things, and where blood wasn't really required. It was more ventilators, wasn't it?
Yeah, so there's a little of the demand side, but it's mainly been a supply issue. So I think that company's well primed. And again, CSL, 90% of its revenue is outside Australia. So it's not really what's happening here in Australia. It's what's happening in the United States and Europe that really matters. And the economy is opening up a lot more, or it has opened a lot quicker than it has in Australia. So I think CSL should do pretty well in the next 12 months.
Okay, Paul, thanks for joining us. That's Paul Rickard of the Switzer Report. If you want to check out the Switzer Report, go to switzerreport.com.au and you can take a 21 free day trial. See you, mate. Thanks for coming on the program.
Thanks, Peter.
And that was Paul Rickard of the Switzer Report. And don't forget, next Tuesday, September 28th, the Microcap Conference. If you want to go to the event, just click on in the link in the description below.